Welcome to today's Skilled MBA Daily Case Study. The topic we are exploring is a modern financial epidemic: free advice, costly mistakes, the Finfluencer trap. In an era where financial tips are just a scroll away, we need to understand the hidden costs of following unregulated advice on social media. Before we dive in, let's establish why this case study, published on December 1st, 2025, is critical for our learning community. For students, this case helps you understand how digital influence fundamentally shapes financial behavior in the real world. For faculty, it serves as a perfect intersection of marketing ethics and behavioral finance, ideal for classroom debate. For industry stakeholders, it highlights the regulatory gray zones of social media finance that businesses and policymakers must navigate. The core message here is simple yet profound. Content is not counsel. Tips are not a plan. So, how does the trap work? It often starts innocently. Perhaps a cousin forwards a WhatsApp video claiming a stock is about to double. The content is seductive. It uses heavy jargon like breakout or multi-bagger and promises 100% returns in just 3 months. There might be a disclaimer buried somewhere saying, "Not a tip, just sharing," but the damage is done. Once you engage, the algorithm feeds you more of the same, different faces, but the same dangerous confidence. The reality check? Most of these creators are not SEBI registered. Their expertise is often an illusion designed to drive revenue to their courses or broker links. The financial advice industry thrives on the like, share, subscribe economy, prioritizing clicks over suitability. Creators profit through courses, brokerage referrals, and paid groups, yet face zero accountability. This unregulated environment leaves investors vulnerable, as they follow generic advice without personalized suitability checks, risking financial missteps. Algorithms prioritize engagement over financial planning, focusing on watch time rather than wealth. They offer generic advice without considering individual factors like income, goals, or risk appetite. Emotional tactics like fear of missing out and urgency are used to manipulate decisions, often leading to unsuitable financial choices. Finfluencers profit through ad revenue, affiliate commissions, and paid communities, while investors bear market risks without proper guidance. Wrong moves can lead to compounded opportunity costs, and there's zero recourse when portfolios crash. The key asymmetry lies in the lack of Securities and Exchange Board of India registration, meaning no fiduciary duty or protection for investors. Finfluencers captivate with short, engaging content, offering clear directives like, "Buy this," creating an appealing, judgment-free zone. In contrast, real advisors delve into complex topics like asset allocation and insurance, often asking uncomfortable questions. The allure of simplicity and certainty in quick clips emotionally outweighs the rational depth of comprehensive financial planning. Finfluencer trust thrives on relatability and storytelling, creating a sense of "I'm like you." In contrast, advisor trust should be rooted in Securities and Exchange Board of India registration, transparent fees, and fiduciary duty. The irony lies in fearing advisors for product sales, while finfluencers sell courses and deals without regulatory oversight, often leading to delayed financial losses. Avoid impulsive actions after watching financial content. Verify if the influencer is Securities and Exchange Board of India registered and transparent about conflicts. Use their content to grasp basics like systematic investment plans and asset classes, but rely on qualified professionals for real decisions. Investing in genuine advice is more cost-effective than making poor financial choices. Behavioral finance highlights fear of missing out and herd behavior, impacting investor decisions. Marketing strategies leverage personal branding and engagement funnels, often blurring ethical lines. Securities and Exchange Board of India's regulatory gaps raise questions about stricter financial influencer oversight. Responsible financial technologies must balance content use without exploiting fear of missing out. Future managers must navigate ethical boundaries in influencer collaborations, ensuring consumer protection and financial literacy. Hidden incentives in free advice often mask misaligned motivations, creating a dangerous cocktail when combined with algorithms and low financial literacy. Real planning, though slower, is safer. Strategic ignorance is key for long-term wealth. Master of Business Administration students should design a responsible Finfluencer code of conduct, focusing on disclosure norms, risk warnings, content boundaries, and an enforcement framework.